Welcome to Tech Money Madness. This is your daily U.S. stock market deep dive. It is May 22, 2026. And listen, if you look at Wall Street today, the champagne corks are just popping.
Oh, absolutely.
I mean, we are talking about record highs. Just green arrows everywhere you look on the board.
Right.
But, and this is the crazy part, if you walk out of that penthouse, take the elevator down to the ground floor and just step out onto Main Street, consumer sentiment just crashed to a fresh, honestly terrifying record low.
Yeah, it's brutal down there.
It really is.
Yeah.
So today we are exploring how the exact same economy on the exact same day is producing two totally different, just wildly contradictory realities.
Two different planets, basically.
Exactly. We're going to break down the mechanics of what this actually means for you. Like what it means for your investment portfolio, your monthly rent, and the very real countdown to your next trip to the gas station.
Which is coming up fast.
Very fast.
Yeah.
And to do that, I've got the perfect expert across the table to help map out how these two extremes can, actually coexist.
Well, thanks. It is genuinely one of the most extreme split-screen moments we've seen in recent memory.
Yeah.
Yeah, I mean, when you look at the raw data right now, it feels less like two sides of the same economy and more like dispatches from two entirely different countries.
Well, that's a good way to put it.
But there is a very strict mechanical logic to how this happens. It isn't random. And understanding that underlying logic is kind of the only way to navigate the economic landscape that is coming at us over the next few months.
Okay, let's unpack this because we need to look at the actual architecture of this Wall Street party. The numbers are just staggering.
They really are.
The Dow Jones isn't just up. It is up 0.9%, hitting a brand new record high. And this is being driven by, the heavy hitters. We're talking Goldman Sachs, Caterpillar, Stellantis.
Oh, right, the traditional giants.
Exactly. It's finance, heavy machinery, global auto manufacturing just leading the charge.
Yeah.
And the S&P 500 is up 0.7%, which puts it on track for its 8th consecutive weekly gain.
8 weeks.
8 unbroken weeks of winning. And the Nasdaq Composite is up 0.5%. The top gainers are Qualcomm, Apple, Stellantis again, and the most active stocks trading hands right now, Nvidia, Apple, and Microsoft. It is just this massive tech and heavy industry bonanza.
Which paints a picture of absolute corporate invincibility. Right?
Yeah, exactly. But then, you walk out onto Main Street and the picture violently changes.
Total whiplash.
Total whiplash.
Yeah.
Consumer sentiment has tumbled to a fresh record low for the month of May. The fear on the ground is just palpable. People are terrified of higher prices stemming directly from the U.S.-Iran war and these persistently elevated oil prices.
The oil situation is the real catalyst there.
It is. Global oil inventories are dropping so incredibly fast that there's a literal mathematical countdown in place. We're looking at a window of about 4 to 6 weeks before gasoline, diesel, and jet fuel prices are expected to absolutely spike. So, to me, this feels like the penthouse is throwing a massive, roaring 20s-style blowout, while down on the ground floor, people are literally checking the couch cushions to prepare for a gas price spike. How do these two things exist in the exact same physical space?
What's fascinating here is the fundamental difference in how these two groups experience time.
Time. What do you mean?
Yeah, time. So markets are entirely forward-looking mechanisms, right? Wall Street isn't pricing in the reality of today. They are pricing in what they calculate the world will look like 6, 9, or 12 months from now.
Okay, I track that.
They are structurally designed to look past immediate pain. Consumers, on the other hand, live almost entirely in the present.
Because they have to.
Exactly. If you're managing a household budget, you aren't trying to calculate the discounted cash flow, which is basically, estimating a company's future value based on the money it might make tomorrow of a tech stock a year from now.
Right, you're trying to figure out how to get to work next week.
Exactly. You are looking at the countdown clock on oil inventories today.
Because that 4 to 6 week window before gas and diesel prices spike isn't a theory. It's a fast approaching wall.
Precisely. And remember, diesel isn't just fuel for long-haul trucks. It's basically the hidden tax inside absolutely everything you buy.
Oh, wow. Yeah, of course.
It's the cost of getting the milk to the grocery store, the clothes to the retailer, the packages to your doorstep. So that consumer terror, it is entirely rational.
They're feeling the pinch first.
They're the ones who have to absorb the immediate shock of those empty oil reserves. Investors are just busy looking right over the consumers' heads at a horizon that they believe looks incredibly bright.
Okay, so consumers are panicking about the geopolitical situation, specifically the U.S.-Iran war and what that means for oil supplies.
Mm-hmm.
But if that is the reality on the ground, why is Wall Street so wildly optimistic about the horizon? What specific mechanism are they seeing that the person buying groceries isn't?
So Wall Street is pricing in a geopolitical relief valve that just hasn't trickled down to the physical gas pump yet. If you look at the bond market today, yields are actually falling. And why? Because Secretary of State Marco Rubio has signaled tangible progress in the Iran peace talks.
Oh, interesting. So they're trading on diplomacy.
Exactly. So while the consumer is looking at current depleted oil inventories and bracing for impact, the bond market and equity traders are hearing the words peace talks and pricing in a future where those geopolitical tensions ease,
Right.
where supply chains normalize and oil pressures subside. They're buying the rumor of peace while the everyday consumer is forced to live the current economic reality of war.
Wait, hold on. You're telling me the penthouse is celebrating diplomatic progress that hasn't even reached the ground floor yet?
Essentially, yes.
But there's another piece to this Wall Street optimism that feels, I don't know, completely contradictory to me.
Good.
We are looking at a massive structural shift happening at the macroeconomic level. There is a potential regime change brewing at the Federal Reserve
Right.
under Kevin Warsh.
Right, the Warsh rumors.
Yeah, and the implication is that the Fed will take a much smaller role in day-to-day markets, basically establishing clearer, stricter rules for intervention, a hands-off approach.
Yes.
But in the exact same breath, the broader U.S. government is acting like a giant Silicon Valley venture capitalist, considering taking direct equity stakes in private companies.
It sounds wild, I know.
Traders are already speculating on targets like IonQ, Micron, and Anduril. How does Wall Street stomach that massive contradiction? I mean, the Fed is supposedly stepping back from day-to-day meddling, but the federal government is jumping right into the private market to buy equity.
It is a profound structural shift, and to understand it, we have to look at it strictly through the lens of market mechanics rather than, like, political ideology.
Okay, lay it out for me.
If we connect this to the bigger picture, what we are seeing is a historic transition away from monetary intervention and towards strategic, state-level industrial policy.
So replacing the Fed's levers with actual government cash. Yeah.
Exactly. For the last decade, the Federal Reserve has essentially been the main character in the stock market, tweaking interest rates constantly, buying bonds, just constantly managing the day-to-day temperature of the economy.
Right, the market hung on their every word.
Exactly. A shift under Kevin Warsh means pulling back from that constant neurotic micromanagement. It means setting predictable boundaries so the market knows exactly when the Fed will and won't step in.
And the market absolutely loves predictability.
They crave it.
So Wall Street prefers a Fed that stays out of the way until the house is literally on fire.
Exactly. But the other side of that coin is the broader government taking direct equity stakes in companies like Micron, which, manufactures critical semiconductors,
Right.
or Anduril, which is heavily involved in next-generation defense technology, or IonQ, pushing the boundaries of quantum computing.
So they're handpicking the winners.
Well, this isn't the government day trading for a quick profit. This is the state acting as a strategic anchor in industries that are now deemed critical for national security and future infrastructure. For Wall Street, this is an incredibly bullish signal.
Because it fundamentally alters the risk profile for regular investors.
Exactly. If you are an institutional investor and you know the U.S. government literally holds an equity stake in a company you're looking at, that drastically reduces your risk.
It's like a stamp of approval.
It creates a highly structured, well-funded playground. Wall Street is looking at a landscape where the Fed is promising not to pull the rug out with surprise monetary policy, and the government is directly financially backing the hardware of the future.
And when we talk about the hardware of the future, here's where it gets really interesting. We have to talk about the absolute behemoth in the room.
Oh, yes.
The biggest engine driving this entire market surge right now is artificial intelligence. The numbers coming out of the tech sector are just mind-bending, and they are creating some extreme winners, but also some very notable losers.
It's a massive sorting mechanism right now.
It really is. Let's look at the undisputed kingmaker right now, Nvidia. Their Q1 fiscal results just hit, and they reported $81.6 billion in revenue. That is up 85% year over year.
Unbelievable number.
They completely crushed expectations. But instead of just marveling at that number, let's look at how they got there. It is almost entirely driven by this insatiable, limitless demand from data centers.
Yep.
They even authorized $80 billion in share buybacks and raised their dividend. And then you have ARM, whose shares just extended a weekly rally to nearly 50%. It feels exactly like the classic gold rush.
Selling the pickaxes.
Yes. Nvidia and ARM aren't out there panning for digital gold. They're the ones manufacturing the pickaxes, selling the shovels, and making absolute billions doing it.
That gold rush analogy is spot on because it explains both the unbelievable profits and the casualties we are seeing in the market right now. The market is aggressively, almost ruthlessly, rewarding the companies that provide the hardware and the foundational infrastructure. If you are Nvidia physically building the chips or ARM designing the core architecture, you are practically printing money.
And that buyback number is just huge.
Right, and that $80 billion share buyback from Nvidia is a crucial mechanism to understand. For anyone who doesn't live in financial models, a share buyback is basically a company taking its massive pile of cash and buying its own stock off the open market.
Taking shares off the table.
Exactly. It reduces the supply of available shares, which makes the remaining shares more valuable. It is a massive signal of confidence.
It tells the market, we have so much cash, and we believe so strongly in our future dominance that our own stock is the best investment we can make.
Exactly.
But, not everyone who buys an incredibly expensive AI pickaxe actually finds gold.
Far from it.
There are some significant losers in this space, and the mechanics of why they are failing are fascinating. Starbucks, for instance, completely pulled the plug on a major AI project.
Yep.
It's like they bought this top-of-the-line AI pickaxe, hiked all the way up the mountain, and suddenly looked around and realized, wait a minute, we just sell coffee.
That's pretty much exactly what happened.
And then you have Microsoft's GitHub, a platform literally built for developers, falling behind newer AI coding rivals, specifically because of recent outages.
Which highlights exactly how discerning and how brutal the market has become regarding AI. We are entirely past the phase where a CEO could simply say the acronym AI on a quarterly earnings call and guarantee a stock bump.
The honeymoon phase is over.
Over entirely. The market is now actively punishing companies that engage in AI fluff. For a consumer-facing company like Starbucks, the integration of AI has to drive a tangible, measurable improvement in their core business.
Like getting coffee out faster.
Yes, it has to move customers through a drive-through line 15 seconds faster, or it has to optimize their supply chain so less milk spoils. If it's just an expensive vanity project that doesn't improve the bottom line, the market will reject it.
So pulling the plug was actually smart.
Pulling the plug was honestly the most prudent financial decision Starbucks could make.
They realized the tool wasn't fitting the trade. But the GitHub situation feels different. I mean, that is a deeply technical platform failing at its core competency.
Exactly. And the GitHub situation shows that even the tech giants are not immune to execution failures. In an infrastructure race, reliability is absolutely everything.
Right.
GitHub is where developers write and store code. If your AI coding assistant has outages, if it goes down when an engineer is on a deadline, that engineer will immediately migrate to a competitor.
Brand loyalty doesn't exist when the product doesn't work.
None. The market demands flawless execution and uptime from the infrastructure players and practical, profit-driving application from the consumer brands. If you fail at either, the market strips away your valuation.
The irony here is that while the government is trying to build a structured, well-funded safety net for the digital infrastructure of the future, the actual physical safety nets for everyday people where they live and how they manage their health are undergoing a massive defensive consolidation.
This is where it gets very real for the consumer.
Right. So what does this all mean? While AI dominates the digital headlines, there are massive financial tectonic shifts happening in the physical industries that dictate our everyday lives. The apartment industry is currently seeing a monumental shift. We're looking at a mega merger between Avalon Bay and Equity Residential. This is going to create one of the largest real estate companies in the entire country.
It's massive.
And over in the digital health sector, there's a massive repricing happening following the absolute excesses of the pandemic era. Ara Health, the company making those smart health tracking rings, is preparing for an IPO to test if public markets are finally ready again for consumer-facing health tech.
This raises an important question about the life cycle of fundamental industries in a post-pandemic high-inflation economy. What you are seeing with the Avalon Bay and Equity Residential merger is exactly what happens when an economy tightens and gets defensive.
How so? Walk us through the mechanics of why two massive housing competitors suddenly decide to join forces.
When interest rates are fluctuating, inflation is a persistent threat, and the basic cost of borrowing capital is high. Smaller real estate players struggle to survive. They just don't have the profit margins to absorb sudden economic shocks.
Okay, so they team up.
So the big players merge. They consolidate to achieve massive economies of scale. They do this to lower their operational costs across thousands of properties and to build what is called a fortress balance sheet, a financial position so strong it can weather almost any economic storm.
But if I tie this back to our Main Street reality from earlier, where consumer sentiment is at a record low and people are checking couch cushions for gas money, what does the creation of a massive mega landlord mean for the average person trying to pay rent?
For the average renter, a mega landlord means a highly corporatized, incredibly rigid renting experience. It might mean slightly more efficient maintenance protocols, sure, but it also means the widespread use of algorithmic pricing on your rent.
Ugh, algorithmic pricing.
Yeah. Algorithmic pricing basically means software is setting rent prices to maximize profit across thousands of units simultaneously based on hyperlocal demand data.
It's no negotiating.
It leaves you, the renter, with absolutely zero room for human negotiation. You can't go to the property manager and explain that you've been a good tenant for 5 years. The algorithm sets the price and you pay it or leave.
Wow.
It is defensive for the corporation, yes, but it is also about ruthlessly dominating market share in a fundamental human need, which is shelter.
That is a stark reality for the ground floor. And what about the health side? I mean, Ara Health going public right now seems like a massive gamble given how pessimistic those same consumers are.
It really is.
If people are worried about buying diesel fuel or negotiating with a corporate mega landlord, are they really going to drop hundreds of dollars on a premium health tracking ring?
That is precisely why the R Health IPO is being described across the industry as the ultimate stress test for the market. During the pandemic, there was incredible, almost irrational excess in the digital health space. Money was cheap, interest rates were near zero, and any company promising to monitor your health remotely got millions in venture funding.
Everybody had a health app.
Everybody. But now that sector is facing a severe reality check. The easy money is completely gone. Ara testing the waters with an IPO right now is a way of asking the public markets a very specific question.
Which is?
Are consumers still willing to pay a premium for proactive, tech-enabled health monitoring in a tight economy?
It's the canary in the coal mine for consumer spending.
Exactly. If consumers are checking couch cushions for gas money, they certainly aren't buying a premium sleep tracking ring. So if Ara actually succeeds in going public right now, it proves to Wall Street that there is a permanent, recession-proof upper middle class that will prioritize tech-enabled health over everyday inflation fears.
So it's testing the waters of wealth inequality almost.
Sort of, yes. Just like the housing market consolidation, it reflects a maturing, hardening economy where only the most proven, resilient products survive. If Aura succeeds, it proves the appetite for high-end consumer health tech is bulletproof.
And if it struggles?
If it struggles, it confirms that consumers are pulling back entirely to focus on absolute, bare-bones necessities.
It really is a remarkable, almost dizzying landscape to step back and look at. We've mapped out quite a journey today.
We really have.
You are essentially caught right in the middle of this massive economic tug of war. On one side, your 401k or your investment portfolio might be looking absolutely fantastic.
Soaring.
Riding the soaring highs of the AI gold rush,
Yeah.
fueled by Nvidia's unstoppable hardware dominance and bolstered by the promise of geopolitical peace talks, making Wall Street feel safe and secure.
Right.
But on the other side, your very real physical cost of living is about to be severely tested. You have this tangible 4 to 6 week countdown ticking away until the pain at the gas pump becomes unavoidable.
It's coming.
You have mega landlords consolidating power and utilizing algorithms over the housing market, and tech companies treating your disposable income as a stress test to figure out what you are still willing to spend money on. It is the ultimate split-screen reality.
It is. And as we synthesize all these moving parts, the tech booms, the geopolitical shifts, the corporate consolidations in housing, I think there is a deeper structural trend emerging that is really worth pondering.
What's that?
If the U.S. government is increasingly becoming a major equity shareholder in foundational technology companies, essentially providing the ultimate safety net for Wall Street's future.
Yeah.
And at the exact same time, traditional landlords are merging into these untouchable, highly efficient megacorporations that control massive swaths of our daily housing. Are we rapidly moving toward a future where the line between public infrastructure and private enterprise completely disappears?
Wow. That is a fascinating, slightly terrifying thought to leave on. The penthouse and the ground floor might be operating on completely different timelines right now, but eventually they are part of the exact same building, and the foundation affects everyone.
It really does.
Well, thank you so much for joining us on today's deep dive. We hope this breakdown helped clear up some of the extreme contradictions in the market today. Keep checking those couch cushions, keep asking the hard questions, and above all, stay curious. That's all for today's deep dive on Tech Money Madness. Don't forget to like, subscribe, and we'll see you tomorrow for more market coverage.